Buyers often expect negotiation to be a single, high-stakes haggle over the purchase price before signing the contract. Thinking of the deal this way ignores the reality of the process. In a transaction, negotiation is a sequenced framework used to manage risk across several weeks. You have to navigate 4 distinct stages: pre-contract, inspections, the appraisal, and the final walkthrough. Your focus moves from price structure at the beginning of the timeline to risk mitigation as you get closer to the closing date. Expending all your leverage in the first few days leaves you defenseless when the house is actually under a microscope. Ignoring this timeline creates vulnerability to unexpected out-of-pocket costs and unaddressed repairs. In the pre-contract stage, fixating solely on a lower purchase price can be counterproductive. A 10% price drop barely impacts your cash to close. It lowers the loan balance, but does nothing to protect your upfront capital. Look at the difference when negotiating a seller credit instead. The cash-to-close requirement drops immediately. You might pay closer to asking, slightly increasing the loan amount, but you keep more cash in your bank account. Cash-limited first-time buyers often find that prioritizing the structure of the deal is the only way to survive high closing costs. Preserving liquidity during your first year of homeownership is mathematically safer than chasing a slightly lower monthly payment. Negotiating the offer structure is what actually protects your long-term financial plan. Once the contract is signed, you enter the inspection period. This window is designed specifically for buyer protection. This is where you identify the difference between cosmetic wear and material defects, like failing roofs, outdated electrical systems, or plumbing issues. Finding these defects gives you the third-party data required to negotiate for repairs or price adjustments before the sale is finalized. Focusing on safety and insurability gives you the highest leverage. Demanding fixes for purely cosmetic issues usually destroys any remaining goodwill with the seller. Specialized reports, like the 4-point and wind mitigation inspections, are often mandatory to secure homeowners insurance. If a property fails these inspections, a seller credit won't help. The repairs must be finished before the loan can close. Inspections verify that the property is safe, insurable, and financeable. The appraisal stage serves the lender by verifying the property's value before they release the funds. A value gap occurs when the appraiser's number comes in lower than your agreed contract price. This chart shows how the gap halts the transaction. The lender will only fund the loan based on the lower appraised value. To solve this, you have to renegotiate the price down, bring additional cash to the table, or cancel the contract. Paying out of pocket to bridge that gap is dangerous for buyers with limited savings, though it can be a calculated move for those with high liquidity. Offering aggressively over the asking price is only viable if you have a clear defense plan for a potential value gap. The final walkthrough happens just hours before you sign the closing documents. This is your last chance to confirm the agreed repairs are finished and that no new damage occurred while the seller was moving out. If you find an issue now, you may need an emergency negotiation, like an escrow holdback, which can delay the closing. This is a final safeguard against surprises, rather than a second opportunity to negotiate for cosmetic preferences. This stage ensures you don't inherit material damage that happened during the seller's transition. Every buyer uses the 3 pre-contract levers differently: price reductions, seller credits, and interest rate buydowns. Comparing these side by side shows how they address different financial constraints. Seller credits are for the cash-limited buyer, solving the immediate hurdle of upfront closing costs. Price reductions work for the value optimizer, who wants to lower the principal balance over the long term. An interest rate buydown uses cash upfront to lower the monthly payment for the life of the loan. This only produces a positive return if you stay in the home long enough to reach the mathematical break-even point. While you can combine these tools, your strategy depends on what the lender's specific program allows. The most effective negotiation tactic is the one that addresses your specific cash or payment bottleneck. For a strategic buyer, the ultimate form of leverage is the contractual ability to walk away. You should map out your walkaway point long before you write your initial offer. Having a predetermined limit prevents emotional overattachment during a stressful inspection or appraisal. This leverage requires the discipline to cancel the contract if the seller ignores material defects. Contract deadlines are chronological protective shields that keep your plan intact. Successful real estate negotiation requires deploying the right protection at the right stage to address your specific financial situation.